Okay, for this video, I wanted to cover the individual income tax tables for 2021. So this is your Form 1040 that you're going to be filing for the 2021 tax year, right? So this is the tax return that you as an individual need to file on or before April 15th, 2022. Okay, so I've got the tables in front of us, two slides. This is a slide with the rates, and then we have a second slide where we're going into an example of how the marginal tax rate system works using these tables. So as a reminder, just to start, the U.S. uses a marginal tax rate system, okay? So when you look at these brackets below, the rates that you see apply to each incremental dollar earned. It doesn't apply based on where you fall within the range, period. So for example, and I get this question all the time, somebody that says, well, I earn $40,000, $525 in a given tax year. What if I get a raise and I'm now making $41,000? Does that mean that I'm paying 22% tax overall now rather than 12%? So by getting a raise, I actually earn less money? No, that is not what happens. What happens is your incremental raise, those wages are subject to tax at the 22, but all the income that falls within these ranges is still subject to these tax rates. So let's look at an example on the next slide, and we can figure out how these tables work. So in our example here, we have John. He's a single filing taxpayer. He's got a W-2 salary from his employer for $55,000 per year. He also has a savings account which pays him $150 a year in interest income. John does not have any itemized deductions, so he's going to be using the standard deduction for 2021. Okay, so John's total gross income is $55,150, right? So he's got the $55K in wages, $150 in interest, so $55,150. Now, after John takes his standard deduction, which is $12,550 for a single filer in 2021, his taxable income is now $42,600. $55,150 minus $12,550. That's how he gets the $42,600. Now, when we have the $42,600 in taxable income, we take that data over to the rate table and compute the amount of tax within each range, right? So $42,600 puts him within this 22% rate bucket, but again, it's only the income that falls within this range that is subject to tax at 22%. So the first $9,950 that John earns is taxed at 10%. So 0 to 9950 is at 10% for $995 in taxes. Now within the second range, the amount of income in here is $30,574, right? The $40,525 minus $9,951. That income bracket is going to be taxed at 12%, so for a total tax of $3,669. And then the income in the next bracket, remember John's taxable income is $42,600. So he takes $42,600 minus $40,526, because that's the floor in this range. So there's $2,074 in income, taxed at 22%, which is $456 in taxes. So once you've computed the tax for each range, you add them all up and you get the total amount of tax that John would owe. So in this case, his total tax liability is $5,120 on the gross income of $55,150, or his taxable income of $42,600. Now notice how the $5,120 is a collection of all the taxes within this range, right? So if you're initially doing this and you're thinking, well, my taxable income is $42,600 and I'm in this 22% range, so I'm going to multiply by 9,372. That is wrong, right? That's not how taxes are computed in the U.S. You compute the tax at each level, okay? Okay, so that covers it for this video. Very simple tutorial on how the marginal rate system works and what the 2021 tax tables look like for individuals, married, filing joint, and then your head of households there. So I hope that was helpful. If you have any questions, leave me a comment below, and I look forward to seeing you again soon. Thank you.